Hello, everyone. My name is Kathleen from the Gurobi marketing team. Thank you for joining us for this hour-long Optimizing Your Financial Future webinar event with Gurobi customer MyGoals. There will be time reserved at the end to answer questions. Please feel free to submit your questions using the Q&A feature. If we can't respond to your questions directly, we'll make sure to respond to you individually shortly after. Today, you will be hearing from Kausal Chen and Ralphie Zayance from MyGoals. With MyGoals, you can access personal financial advice in an entirely new way. Instead of relying on generic financial plans based on rules of thumb, MyGoals helps its customers to define multiple financial life goals and designs a plan to get them there. Kausal Chen joined MyGoals from York University Applied Mathematics program, where he specialized in optimization modeling. He's now the head of R&D and is instrumental in all facets of software development, including core optimization modeling and cloud infrastructure. In his spare time, Kausal likes to study UI design and is a huge soccer fan. Ralphie Zayance is co-founder of MyGoals. He has 30 years of experience in sales, business development, and strategic growth initiatives globally. He has worked and consulted with some of the largest banks in the world and has run global software and data businesses. Without further ado, I'll turn it over to you, Rafi.
Thank you, Kathleen. Good morning, everybody. Thanks to all of you for taking time out of your busy day. Believe me, you want to hear from Kausal more than me, so I won't take up too much of your time. Just a quick intro. We'll go through who we are, where we're based, and some of the high-level complexities of the savings and tax regimes. We're based in Canada, but really everything we've built is multi-jurisdictional by intention, very relevant globally. And then Kausal will take you through a quick demo, talk about how we work with Gurobi, and then the most interesting part will probably be Q&A. Okay, so let's get started real quick. We're based in Toronto, Canada. First day of baseball, opening day, so spring is officially here. We built something very unique, and really we could not have done it without Gurobi. We combine all sources of savings and income, and we help our clients both optimize both their accumulation during their careers, and then to optimize their decumulation, meaning how should I prioritize my accounts? What should I invest in? How much and when? How much should I withdraw? When should I take Social Security? Questions like that. But the real question we ultimately answer are, how do I maximize my after-tax retirement income? And combined with, how do I leave the most legacy possible to my heirs? Okay. We really designed the software to help at all levels of income, whether someone's at the lower level of assets and income or at the higher level, it doesn't matter to us. We bring in all of the unique programs really specified at those levels. We track all of your financial goals, things like a 529, or in Canada, an RESP, education savings for your children, retirement, real estate, all your hopes and dreams. We organize it in one gigantic cash flow projection. We're looking to grow the team, which is always good news. And really, what makes us most excited, aside from being able to help people, this is not a Canadian native solution. This has global implications. All countries right now all retirees are facing questions: how do I best and most efficiently pay myself? And really, the message, I can't drive this home enough. We couldn't have done this without Gurobi, not just the software, but the support. We wanted to joint R&D. The team, Tracy and everybody, has just been absolutely phenomenal to work with. If you think of us sort of schematically, we would sit right in the middle of these four silos: applied mathematics, tax and accounting, big data and cloud computing. AWS loves us. What we do is very computationally intensive. And ultimately, this all leads in our ability to give people a very unique and mathematically superior financial plan. The president of one of the largest wealth management firms in Canada said this to me face to face, not even virtual, but in a literal meeting. I was, kind of bragging and very proud of our accuracy of our calculations, meaning if everything were to happen as we predict, that number could not be beaten. It is the most superior retirement plan you could have. But he said to me something fascinating, that for us, these are all outputs, but for all of our competitors, these are inputs. So wealth planners, financial planners, they sit there guesstimating. And then, after 10 or 12 hours, they have sort of a pseudo optimized plan. What could take us a few minutes could save hours and hours of time, really making all of their employees much more efficient. So he didn't want me just to focus on accuracy. He said we should be focusing on speed. So this is his thought, not ours per se, but we do agree with him. Getting into just some of the local idiosyncrasies. Cosmo, if you can go to the next slide. When we run tests, our whole industry is based on what we call rules of thumb. Because this is so mathematically intensive to do, the industry is based on trusting professionals and taking their advice. So we've benchmarked a lot of these basic plans or naive plans to the optimal plan, generated with Gurobi. And on average, we can add about 2 to 10% a year for the entirety of the plan, okay, in additional income or legacy. Usually for most, probably around 5% or so. Interestingly, the more complex the plan, the more the value of optimization increases. So we've run plans, we've added 20% or plus per year in value over the naive plan. But what we've proven time and time again is these general rules of thumb they're never optimal, and they should never apply. What we wanted to do very quickly, because I imagine most of the audience is American and we're based in Canada, is to sort of do a mapping of account to account. So again, we took in our progressive tax regime, the accounts, and that's how the optimization is queued. In Canada, we call it a tax-free savings account. In the US, the equivalent would be a Roth IRA. We have what we call non-registered or after-tax savings, where we have unique dividend taxation in Canada. One of the things that we've optimized is how much capital gains should I realize this year from my after-tax account. We have registered accounts similar to you in the US. We have a registered retirement savings plan, which is our most commonly used vehicle, similar to a 401k in the US. We have Canada Pension Plan, a pay-as-you-go plan, which is similar to the US version of Social Security, where there's optionality. The longer you wait to receive, the more you get to a certain age. We have an extra account in Canada called Old Age Security, which is based on residency. It is taxable, but it's also clawed back. And it doesn't sound that complex, but it's actually the most complex element of the plan, is we try to get you as much as we can. You don't contribute to this. So we've connected all of the levers, all of the bones, okay? And then what we're not saying when to take Social Security or when to take this. We're maximizing income. These are outputs for us, not inputs. At the lower end of income, we have something called guaranteed income supplement, which is an addition to old age security. Again, the other vendors don't really deal with that, and we do, because we want to help as many Canadians as possible. We have something called a locked-in retirement account, similar to a 401k. It comes with a min and a max withdrawal, and different provinces have different regimes. It's not national, it's provincially legislated. We have Canadian-controlled private corporations, most often self-employed individuals, like a doctor, a lawyer, whomever. They have a CCPC, and this is an unbelievably complex way of how to withdraw your savings most efficiently. We've solved that. And then we have, similarly to the US, defined benefit pension plans. We've actually modeled the expected cash flow for the 17 largest DBs in Canada. Love to do it in the US. I imagine there are many more than 17 large ones. And then lastly, this idea of a group RRSP, where the company would match contributions. So we bring in all of these sources of income, and we help prioritize between mins, maxes, which age to opt in, et cetera, in one comprehensive plan. We offer efficient income splitting with spouse. Interesting, in the US, you can, any couple, I believe, married or common law, can split income. In Canada, one of the two needs to be retired. We optimize again during the accumulation phase while you're working, as well as in retirement. And ultimately, the major thing we have in common with the US are this idea of a progressive tax regime, where the more you earn, the more you pay in tax. We call this progressive. Okay. And I'm going to pass this over to Causal now to take you through the demo and the sample family that we're going to show you.
Okay, hello everyone. So I will be taking you through a scenario example here. This is a Gurobi family. We have Jack and Diane. Jack is 60, Diane is 55. Jack's annual salary is 125K and 100K for Diane. The annual expense is 58K and 50K for Diane. So for the account and assets, so for Jack, we have a registered saving account sitting at 600K, 350 for Diane, a locked-in retirement account at 200K, a tax-free saving accounts for Jack at 100K, also for Diane at 100K, and a non-registered account at 500K each. Okay. Diane also has a pension, which she will be receiving during retirement as well. So just a basic scenario. And for the assumptions, both of them haven't collected their government benefit yet, the Canada Pension Plans and also the Old Age Securities. They both have planned for retiring at 65 and planned life expectancy all the way to 95. Their portfolio profile has a mean returns of around 4%, a volatility of around 8.5%, and also their desired outcome is to maximize retirement after-tax income. So let's take this scenario and jump to the app real quick. There we go. Okay, so let's create a new plan. Going into here, the informations that you see before, we've already kind of inputted already, just in the interest of time. So this is the clients that we have, the assumptions that we selected. And now all we need to do is to review all our informations, click the create the optimal plans, and then click create. So this will take a couple seconds. And once this is done, it will take us to the plan overview page. Boom. Okay, first of all, notice that this is just a basic plan, right? The little orange button here indicate that this plan is not yet optimized, but you can still review it, right? You can look at your current net worth, all the assets here that we discussed just now, the liabilities, and you can go through the plans, looking at the decisions, explain to your clients how you deal with risk, and even personally adjusting all of the inputs as we go. But the highlight for today is actually not these. We actually want to highlight the values of optimizations with Gurobi. So without optimizations, the couples can earn about 206K of incomes in retirement. But let's see what happens when we optimize this plan. And to do so, all we need to do is click on this button up here and then click the optimize plan button. So optimization could take some time, depends on the complexity of the plan. So in the interest of time, we actually already optimized this plan. And so all I need to do now is just to pull it up. Okay, I'm going to pull up the optimized plan. Achieve the plan. Boom. Okay, the first thing that you notice is that orange button go from that to a green one that says plan is optimized. And if you see down here now, by optimizing, we actually add 6.24% every year, risk-free, right? You don't have to do anything extra. All you need to do is follow the cash flows that the Gurobi's solver provide. And we go from 206 all the way to 218. Now, let me take you one step further into this to actually compare the basic plan with the optimized plan. So if I choose the strategies here, you can see that if I choose this basic strategies that we created before, the income is 206, right? That's what we saw. And if I select a different strategy, let's go with this one, then this could be a different number as well, right? It's now at 201 compared to the 218 that is the optimum. So the strategy here, for example, looking at the withdrawal strategies, is just taking money from our registered account first, use that up, and then we'll move to a non-reg. After the non-reg, then we'll move to a tax-free saving. Okay, so all of these different strategies that you can select, all of them will give you different incomes. And now let's take one more step into the graph. Boom. let's focus in the retirement graph. And I want to highlight that these colorful bar graph are just the different cash flow components that makes up the after-tax income here after you net it against the tax. So, okay, I want to highlight one more thing, which is this gray line, which is the total after-tax cash flow. On the left-hand side, you have the non-optimal strategy, which is the one we selected up here. On the right-hand side, this is the optimal strategy, okay? So by design, this is the cash flows on the optimal side. And if we were to look at the number of 218s, if I want the same total after-tax cash flow using this non-optimal strategy, you can see that I can get that 218, but up to a certain point, right? Up to a certain point, I'm running out of assets. And this right here actually highlights the values of optimizations, is that we can actually take the difference in shortfalls and then estimate that if you want to go through the entire plan, then you can do it with only 201 rather than 218, okay? So you can select different strategies, go through all the different combinations, but what we have done here, just to kind of save your time, is to actually reveal all the strategies. Click on that. Boom. So you can see these little dots, right? These little dots on the screen is just the different strategy that you can select it from that drop downs over there. And if you take a look, all of these different strategies are always inferior to the green line up here, which is the optimal strategies solved by Gurobi. Okay. All right. So in conclusion, we see that by solving our financial plan model with Gurobi for the optimal cash flow strategies, and also when to elect and receive your government entitlements, we actually add a tons of values here, right? Over 600 basis points every year, risk-free, and through the duration of your retirement, this will actually add to your potential of 385K extra. So that's in itself is already a huge value add. Now, on top of this, value add is not the only thing that Gurobi is adding to the plan. Number two is how Gurobi can actually simplify the model development process as well. So there are 4 key highlights that I wanted to go through today. One of them is the piecewise linear, the min-max constraints, the solver callback, and the irreducible inconsistent subsystem. So number one, for the piecewise linear constraints, we actually consistently use piecewise linear function in our model a lot. One such example is basically to calculate tax, right? So given a taxable income, a tax payable, a piecewise linear function for that graph looks something like this. Without Gurobi, if you want to model something like this, we actually have to construct a set of constraints. So let's go with that. Let's the t variable be the taxable income, the f variable be our tax payable, the b variable just a binary variable, and the s variable is what we call like a segment variable. So let's put all of these together. All right. So the first thing we wanted to do is just making sure that the binary variable, only one of them can turn on at once. So all the binary variable sums up equals to 1. The segment variable is bounded by the binary variable, and the taxable definitions for T and the definitions for F is basically a combination of these points and also the segment and the binary variable. So if we sub in all of these points into the equations and simplify, we get this nice little short equation down here. And same thing for the F variable. So let's simplify all of that and then put into like a little nice summary here. And I'm going to take you through an example. For example, if my taxable income is 3, then I know that my F should be 15, right? So given that T is 3, we're looking at these equations. So take a look. I think B3 could be 1, right? Could be 1. That means all the binary is going to be 0. If B3 is 1, we get 2. S3, because it is bounded by B3, it could also be 1. So that's perfectly at 3. So now that we know B3 is 3, S3 is 3, we can actually put S3 is 1. We can actually put it into here. B3 here is 1, S3 here is 1, so that's 15. Perfect, that makes sense. So this also works when your taxable income is also in between, right? Not just at the points. So for example, if the T is 1.5, right here, we know that the F should be the midpoint between 2 and 6, so that's 4, right? That's 4. So if it's 1.5, T is 1.5, I think B2 could be 1. And then S2, because it's bounded by 1 here, it can be 0.5. And everything else is 0, right? So with B2 is equal to 1, this is 2. With S2 equals to 0.5, that's 2 as well. So 2 and 2 is 4, right? Perfect. So as you can see, without Gurobi, we actually have to set all of this for one piecewise functions. But in our model, we're not only using one of this, we're actually using more and more. But with Gurobi actually abstract all of those cumbersome works, and all we need to do is add this constraint to our model, right? So we're using Python. So in Python, all you need to do is say add general constraint piecewise linear, where the x variable is the taxable variable, the y is the tax payable, and the x points and the y points are as follows. Okay, so that's piecewise linear. Similarly, for the mins and max functions, without Gurobi, we have to set basically a set of constraints just for that. For example, if you want to model something as simple as z equal to max between two variables, x and y, without Gurobi, we actually have to do this. So the first two equations, this is actually equation to enforce the values of b, and b is a binary variable, and the big M is just a constant, so that it is sufficiently big enough, bigger than x and y. And these last four variables is basically to enforce the value of z. Okay, so for example, if I have z equals to max between 5 and 10, so the x value is 5, the y value is 10. In this case, y is greater than x, which then, because of these two equations, implies that b should equals to 0, right? So b here is 0, y minus x is a positive number. This is okay. X and x minus y is a negative number. This is 0. That's okay. So now that we know b is equal to 0, z less than y plus 0, but we also have this constraint that says z has to be greater or equal to y. So the only way that this is possible is that z is equal to exactly y. Okay, and that's how we can actually have the z equals to 10 here. A set of constraints just for something as simple as this. Now without Gurobi, but with Gurobi, all of that is gone, right? It simplifies that whole set of constraints into something like this. All we need to do is add constraints that says z is equal to max of x and y or min of x and y. Okay, so that is the min-max constraint. Next is the solver callback. Okay, so what is the solver callback? The Gurobi solver callback is a features that basically can be used to both monitor the progress of the optimizations, such as obtaining various informations about the progress, and also to modify the behavior of the solver as we go. So what you see down here is pretty much a log of the optimizer, and this highlighted yellow line is not part of the log. This is actually what we injected in ourselves using the Gurobi solver callback. And this features pretty much enable, like it opens up a whole door of possibility on how you want to deal with the progress, right? You can even set your own specifics, terminate conditions, or whatever you want as well. Okay, so that is just kind of like a quick look at the solver callback. The next one is the irreducible inconsistent subsystem, IIS. So an IIS is a subset of constraints and variables bounds with the property that it is infeasible. But if one constraint or boundary is to be removed, then the subsystems actually become feasible. So we needed this because while developing the model, we sometimes run into a situation where the model is infeasible. And since our model is large, it is somewhat difficult to analyze and where and what went wrong. So we can actually use this compute IS functionality to actually help us with this. So what I have down here is just really a simple sample output of what the compute IS looks like. For example, we have a variable client required additional savings, and we constrain it to equal to 0. However, right, the boundary of this variable is actually greater or equal to 1. So therefore, the model is infeasible, and without wasting so much time trying to look for where, and why it went wrong, using this feature, it automatically tells us exactly where it is. So this is the irreducible inconsistent subsystem. And I think that is the end of my presentation. So Kathleen.
Thank you, Rafi and Kassel. We will now turn to our Q&A portion of the webinar with Zed Dean, Technical Account Manager, and Silky Horn, Senior Optimization Engineer at Gurobi. You can submit a question using the Q&A feature. As a reminder, a recording of this webinar will be available on demand and emailed out to all registrants. If we can't respond to your questions directly, we'll make sure to respond to you individually shortly after. I believe we have our first question. Zed?
Yeah, okay. That's a great work, Rafi and Kassel. I had just a quick question. You have done all of this work now. What's really next? How can you take this to the next level?
Why don't I take this one? Kassel, can you scroll? Perfect. We get to ask this question all the time. There's a lot of different ways we want to go, aside from international expansion. The first idea, sort of progressing from left to right, is this idea of asset location. So let's say Zed wants to buy X dollars of NASDAQ 100 exposure in his portfolio. The question is, what account or accounts should he do so in? So we've built a prototype in Excel that we need to move over to the model now. This would probably be a 1-year optimization. And really, just as an aside, you've had low interest rates for 15 years, and that kind of forced people to purchase the wrong assets in the wrong accounts. And I think now that rates are up, people will go back to putting interest-bearing securities into their retirement, their tax-delayed accounts, and buy more dividend and more capital gains-oriented securities in their taxable accounts. The second, we want to optimize capital gains within the Canadian corporation, which is going to be a massive effort. That's a significant issue that we need to deal with. And that would only affect probably about 10% of Canadians, to be honest. We're looking at insurance and annuities, how to optimize the purchase of insurance and when to buy annuities, and rolling those cash flows into this broader plan. I think that's the most interesting of all the things we're looking at. We're considering sort of a click to buy approach where we don't want to partner with any one, let's say insurance underwriter, but to digitize an entire insurance marketplace. And, we would aggregate prices and you can click and buy X dollars of insurance over Y term or whole life and capture all of the tax benefits of that. I don't know in the US if you have, in Canada, we have this idea of an estate module where you can do certain asset freezes for members of your family for capital gains treatment. And then the most interesting to me is this idea of bringing in AI and starting to look at anonymous client data and being able to, you really bring in AI. We can build benchmarks, how are you doing versus retirement peers? So it would be anonymous aggregated data where people contribute and this sort of give and get model. Can we predict when people will actually fall off the retirement rails? Probably. So these are sort of the 5 or 6 ideas that we're looking at right now. And thanks, Ed, for the question.
I have another great question for you. The question is, How do you model future uncertainty in the optimization model? Does your model incorporate the dependence of capital gains taxes on future asset prices?
Kausal, do you want to take that?
Yeah, so I think I can answer that. So in terms of future uncertainty in the optimization models, right now we're basically using a simple linear projections using the portfolio profiles that we kind of showed there. And in terms of model incorporate the dependence of capital gain taxes, yes, we do have capital gains in our model as well, but we're looking at it not from an assets point of view, but more of like an overall account point of view. So, and once the model is optimized, we actually run a Monte Carlo on it in order to generate kind of like a like a 1,000 cases percentage to see how successful that model is as well, so that we can vary the returns and get that answer.
I would say
Nice.
overall, just a quick comment on the capital gains beyond that. This is really not a set it and forget it plan. The idea would be that an accountant or a wealth manager or a financial planner would sit with the client and re-optimize every year as new certainties unfold, especially for capital gain.
We have a couple of questions from the audience about other countries. So for example, Ram is asking, are you planning to have a UK version? Akashi is asking that how can you scale this to other countries and different taxation systems?
It's a great question. Wonder that as well. UK is definitely on our radar right now. US and UK are similar systems to us. Scaling internationally, we have relationships with some of the global large accounting firms, and we're talking to them about things like this right now. We're constrained by time and money, but not imagination, I guess would be my answer.
That sounds great. So I have seen several people asking for whether they can access this demo and play with it themselves.
So not quite yet. We still have to fix a few things. Build a few things, but very, very soon I'll be able to.
Okay, great.
And some were asking also, have you done any benchmarking done for these models? I don't know if you can elaborate on this.
Do you mean in terms of performance or accuracy? What do you mean by benchmarking? Just to be clear.
I'm not sure what exactly
Okay.
the audience were asking, but it's more about a general question. Have you done the benchmarking?
So we have our angel investor has benchmarked us versus competing apps. And that's where our sort of 2 to 10 and then 5 to 20 came from. What we found was the more complex the plan, the more value optimization added. So for a single person, in their working years, we can add some 2-3% a year, but add a spouse and some splitting, a corporation, lots of accounts, and the duration of the plan. And that's where we started to add well above 10%.
Okay, there are a few more concerned with the uncertainty in your model. First one is actually multiple questions. So first is the annual income in nominal term or real term in your example?
It's a great question. What we showed you today, we can do both. What all the models do out there, and I'm going to point to some recent stock market behavior. Inflation and interest rates have been low or zero for very, very long. So what most models do out there in other software platforms, they take expected returns and they add inflation. So if my expected equity return is 5% and I'm modeling 2% inflation, it's going to forecast a 7% return. But as you can see from the last year plus, inflation was 5 or 6% and the market was down 20%. So adding them is not really an accurate thing to do. And we were biased by 15 or 20 years, maybe more, of benign inflation, depending on which country you come from. What we've done, and we didn't demo this, we built in inflation risk into the plan. So we don't want to take a plan and put it into sort of nominal terms and everybody feels extremely wealthy. It's very hard to imagine what $1 is going to be in 20 or 30 years, but we know what a 2023 dollar is worth. So what I would suggest to you, and we'll do both, but we're overstating assets by adding inflation to expected returns and compounding it over time. So we can do both, but really what we suggest is going into our inflation risk and seeing where you live and your returns and your situation, what your exposure to inflation risk really is. So I think that we've built a better mousetrap, but again, as a rule of thumb, the industry likes to add inflation to expected returns and make us all feel very wealthy. But in fact, you can see from market behavior that that's just not true.
Okay, I guess I'll just go on with the further parts of this question. Second one was, you said the added annual incomes are risk-free. How do you deal with the risk of portfolio return in your analysis?
Cosmo, you want to deal with Sigma?
Yeah, so in terms of the annual income being risk-free, this idea is on top of already the basic plan, right? So we assume that whatever the basic plan is, whatever risk is already in there, strictly speaking, the optimizations is risk-free on top of that, not that the risk of the portfolio return is not in there. But we're strictly speaking about that, the optimizations is risk-free on top of that. So.
Okay, that makes sense. And the last part, it looks like the calculation is constant until the fund is running out. Have you considered dynamic withdrawals? I think you've already touched on that, but yeah.
Yeah, so for the dynamic withdrawals, well, right now, yes, in our decumulations, it is a constant, but you can input extra cash flows in there as you need. So if you want to consider that as dynamic withdrawal, I say that would be it. Yeah.
So what we let you do in retirement, let's say Zed wants to model for a travel fund of $3,000 every year. And Zed also likes driving sports cars. So he wants to lease a new Maserati every 5 years. So we can take those sort of custom cash flows, and then the engine will consider both your sort of predefined expenses and then all of Zed's expensive habits in retirement as well. So you'll see it won't be so dynamic. You'll see a sort of a zigzag approach, and everything is different. Something you may purchase up front, other things you can finance over time. Even on the car, we'll deal with the repurchase price of the car on a lease, for instance. So we try to capture really every element of cash flow in retirement in different ways.
Nice. We have a couple of questions from the audience, and actually that's a question from me as well, because I'm Canadian. So how the end consumer can use this? So at the moment, this application exists somewhere. How can the end consumer access it or benefit from it?
So we're working on our first really large institutional deal, but we plan on pushing out the app very soon. And we're contemplating a direct-to-consumer model as well for people who don't necessarily have a financial planner. Really, our business model is more B2B, but that B2B partner is getting us to consider a direct-to-consumer model as well. So, I'll leave it at that sort of high level, but there'll be press. I mean, you can follow us on LinkedIn, whatever. We'll have social media around the launch, hopefully very soon. I saw there was one question just about the meltdown of the RRSP. I saw in our own sort of chat room. We didn't show you this. We didn't go to sort of the meltdown, but very rarely is the minimum withdrawal the optimal strategy when dealing with an RRSP/RIF in Canada. It would be the same with a 401k. So often what the optimizer will do is push out large withdrawals, and it'll earn you other sources of likely annuitized government pension later to pay more tax now, to smooth out that constant income over time. So we really get into the nitty-gritty of the mins and the maxes, and each account is different. In Canada, when you deal with a LIRA, which is a min and a max withdrawal, and a RIF, which has a min withdrawal, and then the optionality of when to take the various government pensions, and the delay that pays to wait, the optimizer does a phenomenal job of bringing in all of these different sources of income, including the embedded optionality in some of them, and the mins and the maxes in others. So again, rules of thumb, withdrawing the minimum is usually not optimal.
I still have, I think, one from the question from the audience as well, asking about, like, since different clients have different investment behavior, do you change objective function in your optimization problem, or you simply update the investment behavior as a parameters that passing through the model.
Yeah, so the objective functions, we actually have only two in our model currently. Yeah, one of them is, for the retirement after tax income. And the other one is looking at maximizing the legacy, where you hold your after tax income constant at some level, and then you want to maximize your legacy. So those are the only two options that we do, right?
I believe that was our last question. That's all we have time for today. Thank you, Kausal, Rafi, Zed, and Silky. Please take a minute to participate in our survey. We would really appreciate your feedback. Let us know if you think there's anything we can improve on, and if you have an optimization project in the near term or have general questions or comments. Thanks again, and we hope to see you at our next webinar.